What's going on, everybody? Good morning and welcome back to Beat the Bell, presented by King Capital. Hope you guys have all had an awesome week thus far. One more trading day before we get to the weekend to talk about what we're looking at today. We've got an awesome panel with us this morning, starting with Money Mander.
Good morning. Apologies for the green screen problems this morning, but happy quad witching to everyone. We'll talk about it in a second.
Oh, that's right. It is quad witching. I forgot about that. Diamond Trades. Good morning.
Mander, you look hilarious, bro. That's funny as fuck.
Tried everything. There's no fixing it this morning.
I love it. Let's get into it.
All right. And Stock Snipa.
Good morning. Quad witching. Let's get fucking rich.
Okay. All right. Fed forecast.
Let's say Fed forecast first. We had a lot of data this week. We had a lot of data today. As far as the economic calendar, today, the only thing that's yet to come out is UMISH at 10 o'clock, consumer sentiment. We did have import prices and export prices coming this morning, all in line with expectations, nothing really there. The one thing, we got New York Empire State Manufacturing Index this morning at 8:30, came in at 1.9 versus a -8 expected. So for the manufacturing indexes, when it's above zero, that's basically showing confidence by manufacturers. And when it's below zero, that's the opposite, showing negativity. So a surprise upside beat there on the New York State Manufacturing Index. We'll have to see how Michigan consumer sentiment comes in today at 10 o'clock. So this week, the market has rebounded strongly following its weakness early in the week, propelled by the latest batch of inflation data. So far this week, we've gotten a CPI print that came in perfectly in line with expectations. So I guess no news there is good news. Consumer spending increased in August, with retail sales coming in at 0.6% increase month over month versus the 0.4% forecasted, showing strength of the American consumers, may help to stave off any impending economic slowdowns. Thursday did bring a hot PPI, which measures producer prices. PPI came in at a 0.7% increase on a month over month basis, higher than the 0.4% expected, but markets shrugged that off. Some traders believe that the price increases may be due to rising fuel costs, however, which are oftentimes ignored by the Fed in their evaluation for whether or not to raise interest rates, because energy prices can be so volatile. All of this led to a broad relief rally across the markets, with the S&P 500 and the NASDAQ both adding 0.8% yesterday, and the Dow led the way up 1% on the day. The hotter than anticipated prints did not sit well with the bond markets, as the benchmark 10-year fell, pushing yields to 4.289%, still hovering up there near that 4.3% near year-to-date highs. The dollar has also caught a bid amidst the news of a hotter than anticipated economy. The dollar and yields going up generally puts downward pressure on equities, which hasn't been the case over the past 2 days. So we'll have to see which reconciles first. As I'm speaking here, the indices are selling off here in the pre-market, so that may be the reconciliation that we were looking for. But I'm sure that we'll get further clarity next week with the FOMC meeting to come on Wednesday. Last bit is oil. We don't talk often about oil on Fed forecast, but I think it's worth talking about today. Crude oil futures extended their multi-month uptrend amid supply tightness and higher than expected CPI and PPI, a signal that consumers are still spending. Edward Moya, senior market analyst of Oanda, expects the oil price rally to continue in the coming months, stating that the risks of significant supply shortfall should have many traders eyeing the $100 level over the next couple of months. Crude oil futures are currently trading at about $90 a barrel. So we'll see if he's right on that prediction to the upside. That's all I got. Mander, what's up?
Yeah, fantastic segment this morning. I was going to segue off of the OPEC thing before I get into mine and the oil. So OPEC, I read, projects about a $3 million barrel per day shortfall next quarter. And so I think if we really start to see a push up into that last summer's highs above $100, it's all really thanks to the Saudi and Russian exports being reduced that we were kind of talking about a couple of weeks ago. And now you have China reopening post-pandemic, accounting for like 75% of the increase in demand. I think more so, as you mentioned, the Fed's going to look at core inflationary measures and try and exclude that energy volatility. But I think more so from the consumer standpoint, if you start to have all of these other things start to uptick with inflation going back and energy prices, and what I'll cover here in a second, I think going into those retail sale numbers and the strong consumer we've been seeing could finally start to have some really negative headwinds coming at them. And another one that just came out overnight is the United Auto Workers Union just began strikes at all three of the big three domestic factories here, with Ford, General Motors, and Stellantis, which is the parent company for Mopar vehicles and Dodge, Jeep, Ram. They all saw workers leave exactly after midnight from methodical locations as they didn't come to new terms over wages and job security. And so they left the Ford Bronco factory, the Chevrolet Colorado factory, and the Jeep Wrangler, which was strategically like the most profitable vehicles that they all make. Goldman Sachs is calculating here that 46%, which is nearly half of all domestic auto production, comes from these three companies alone. And so if then we look forward here into quarter four GDP estimates, the other one, Ryan, sorry. If we go into quarter four GDP estimates here, Goldman Sachs is projecting that every single week the strike last year, we could see roughly a 0.1% loss in quarter over quarter growth, on top of the other things in this segment here, with a potential government shutdown looming in quarter four and the resumption of student loan payments coming in October next month. All of these things kind of on top of the run up we're seeing in energy prices, all of these are going to hinder at consumers' expendable money for other purchases that pretty much every single company leading the S&P 500 is based off of right now. And so if all of your expenses are going up, production is coming down to some of these automakers, driving up car prices, you're going to start seeing student loan payments come back. All of these things I think are going to present a pretty negative headwind that we'll have to see which one gives first. As he was mentioning, the dollar rising, yields are rising, all on this news, and we're starting to see equities get this bounce back in September after the week start. So one of them is going to have to give, and we'll see what we get. But coming into OPEX today, or quad witching, quarterly OPEX here, we have a record $3.4 trillion in notional open interest across all option facets here. So we have $2 trillion of SPX options maturing at the end of the AM session here with those morning option expirations, and then about $1.4 trillion of everything else expiring at the close. And so I think, needless to say, expect some rough and violent seas here today, as you're going to have dealer positions getting unwound. You're going to have hedges from all of these $3.4 trillion of notional open interest getting added, getting exited, positions going into the money, out of the money. It's going to be probably a whipsaw, really violent day here of price action with just so much notional open interest sitting there. But we'll see what we get. And that is all I have for this morning.
Yeah, that's really about it. OPEX, obviously trade careful. The real volatility, and we've talked about this on previous OPEX, is that the real volatility comes in like right before the open and like right after the open. I think really like middle of the day should really be like unaffected. But yeah, we'll have to see what price action gives us. That'll wrap it up for Fed forecast. Pass it back to Alejandro.
All right, awesome, guys. Great segment this morning. Let's talk about the S&P. So we recently got the buy signal. Everybody knows that because they've been watching the system. So we got the bullish cross of the 10 SMA over the 50 SMA on the hourly chart, which in my opinion was, the real important signal here, because the 50 SMA on the 1 hour chart was serving as resistance. The guys mentioned it. Today is quad witching. It's likely to be, a choppy and difficult day to trade. I'll certainly be taking it light today after what was a really nice week, and yesterday being able to capture the move after what felt like a really tough grind to start the month of September with very little trend. I'm more than happy just to take things lightly today. But if you do plan on engaging and you do plan on doing some trading, you're obviously going to want to watch for the 50 SMA on the 30-minute chart to continue to serve as support. And you're going to want to outline those zones that you are interested in to buy dips. Now that we are back above the 50 SMA on the hourly chart, we know that the bulls are in control. And so personally, how I will be engaging is I will be looking for opportunities to get long as we are starting to develop into this new buy signal. And I am still holding a bit of my position long with trailing stops. And again, I may just kind of sit on that for the whole day, depending on how things look. But that's what we got going on this morning with the system. Pass it over to Stock Snipa now for Beth Bell.
Good morning. It's time for the best part of the show. As you guys all know, got some pretty interesting questions for you guys today. But let's take a look at the statistics here. We can see that Diamond is sitting at 61 wins and 29 losses on the green or red at a 68% win percentage. I'm going to go ahead and dive into our first question from there, which you guys all know will be green or red today. I'm going to go ahead and start this one off with Money Mander.
I am going to take a slight red day today after the big upside we saw yesterday.
Okay, that's valid. Diamond Trades, what do you got?
I actually like that. I'm gonna ride with Mander here. I'm gonna go red.
Alejandro, what you got?
This is my shot. I'm going green.
We're sitting pretty nice up right now in the pre.
We're
Definitely.
actually red right now in the
I was about to say we're definitely not green.
Oh crap!
Can we get a new green or red guy? This guy doesn't even know if he's green or red.
Yo, whatever. I'm gonna take green though. I think that we can bounce back up. For some reason, I thought that we closed lower than where we closed. Whatever. Aside from that little blunder right there, I'm gonna go ahead and jump into the fun stuff now. My next question is: would capping credit card interest be a good idea? Now, there is a bill out there where they are trying to make 18% the highest that they can charge for credit card interest. Now, you pay your credit card on time, you'll have no interest for the most part. So personally, I think that this just kind of caters towards irresponsibility. But Alejandro, what do you got for me? Should they cap the credit card interest 18%?
I guess in theory it would be nice for people in who are not responsible with using their credit cards, but I don't know. It doesn't really. I don't think it makes sense, and I think credit card debt is credit card debt, and it's kind of helping out the wrong people, right? If you are, in a position where you are deep in credit card debt and you do not repay that credit card, it's again just not helping responsible individuals, which kind of screws up the entire system, like the credit score system and whatnot. Because I want to be rewarded for being responsible. For example, when credit card companies like to see you use less than 10% of your available credit each month, things like that are what the credit unions like to see. And so, I don't know, I think it kind of evens the playing field a little bit if there is a cap to the amount of interest that you can incur.
I see. Money Mander, what do you got for me?
So I think obviously it would benefit the economy. You would just have consumer spending go up with, a cheaper cost of borrowing. But I think, is it a good idea holistically? No, because you have to think if they're capping, high risk lenders at 18%, then if you're like a 750 plus credit score with really great credit, what's your credit score going to, or what's your interest rate going to be, like 12%? And at that point, you're having credit card debt come out pretty much similarly to where, an auto loan would be at to get a whole car. And so I think it's all based off the federal funds rate, obviously. And so I think if you try and cap that, you're going to really put a lot of compression between two very different types of debt if you can only, put it up to a certain percentage. If the federal funds rate's sitting at 5.25 and then you're going to have credit card debt at 18, it really puts a lot of pressure between a mortgage and credit card debt, which is very different types of debt there.
I like it. Money Mander with Liberty 2 on his head. Diamond Trades, what do you got for me?
I kind of agree with Sal's position like a bit because it obviously should vary. I don't think that there should be a cap because it obviously depends on like where interest rates go. I think putting a cap on it is a bit dangerous because you obviously don't know what the environment's going to look like down the road. I do like the idea of taking some of the debt burden off of some folks because I do think that it does. It's a lot, like Alejandro said, like it's a heavy burden to carry, and obviously that comes with being financially responsible in X, Y, and Z. But I think that at a certain level it becomes like crippling, to the point where it can really affect people's ability to sort of participate in the economy. So I would agree with Mander. I think something should be done about it. I don't know if this is what should be done about it. That's just my take on it.
I'm going to have to almost perfectly agree with you. I think that, this does incentive. This capping this at 18% will eliminate some incentive for people to pay their credit card bills on time. So I can see why institutions are pissed off about this. I'm going to go ahead and jump over towards the third question we got for the day. And this is an interesting one, and I'm really interested to see on what some of you guys have to say. But you have to put all of your money, and keep in mind you have to hold these stocks for one year. But you have to put all of your money equally in Apple and Carvana or you're going to take Microsoft and AMC. I'm going to start this one off with Alejandro. Muted.
I'm going Apple and Carvana. Every time you've asked me about Apple, I mean, we got to change this up. I'm going to pick Apple every time. I mean, the viewers know this by now. It's kind of
listen though. You're putting half of your money in Carvana also.
I understand. I don't want half of my money in Microsoft, is what I'm saying.
Okay.
I need half the money in Apple. And God forbid I put a fucking dollar in AMC. Jesus Christ, dude. I mean, like, imagine half of your net worth is reliant on the AMC share price. Like, how could you live?
Worth on Carvana.
I disagree. I think that Apple and Carvana is the obvious one here.
Oh, man. Diamond Trades, what you got for me?
I'm gonna after Alejandro's little spiel, I don't feel great about going this direction, but I'm gonna take Microsoft and AMC. I think when you look at let's dissect this, right? Let's start with AMC. When you look at AMC versus Carvana, AMC is currently trading at like 52-week lows. Carvana's up what, like I have the chart right here. It's up, I think, several hundreds of percent. Carvana is up 750% since May. So you have a 7x in the stock, right? Over the last 4 months. And as we know, I mean, as Money Mander knows, Carvana is not, our favorite company. So to see that sort of run up, and that's in that type of stock, it's just it's not super attractive to me. I'm going to take AMC. And then Microsoft. I mean, Microsoft is on the cutting edge of this sort of whole AI movement that we have going on right now. They're literally on the front lines, right? So, I mean, they have a lot of upside potential as well if they can capitalize and really execute on this new trend. I'm going to go Microsoft and AMC here.
I like it, dude. I like it. Money Mander, which one are you going with?
Mine should be obvious. I thought I was going to be the dark horse here, but I'm following Noah, and I think – if I look at Carvana, if you just look at the stock price, it is probably the highest performing stock out there on the year to date. But I just don't like the company. I don't like the business model. I don't like anything about it. And I can say the same thing for AMC because that company is an absolute piece of shit. So those are sunk costs in both of them, right? I'm going to act like they're not even there because I don't want to own either. I like Microsoft's business model over Apple's, and I refuse to ever have a share of Carvana regardless of how it performs in the short term. So I'm going to take Microsoft and AMC.
I like it. I like it a lot. I'm going to have to agree here. AMC at the lows versus Carvana all the way up here. What are the odds here? AMC has at one point been the best performing stock in U.S. history for anybody who may not know that fact. But when AMC was going through its little run, if it even did half of that, in the future, more than a year from now, shit, like
Carvana's up 1,000% year to date.
That's insane.
So there's that as well.
That is. Yeah, it's up 1,000% currently right now. So keep in mind, I'm putting half of my money in the stock that is up 1,000% in this year. I don't really like it. I'm a big Apple advocate, but I'm going to have to take Microsoft and AMC. And I just want to point out that Alejandro thought this was obvious, Apple and Carvana. But
now it's even more obvious that you guys picked the other three. Or the three of you picked the other one makes it even more obvious now. Now I know 100% I would be right.
Well, I don't know,
Contrarian investor.
I don't know, dude. I really don't know. Agree to disagree. But I'm going to go ahead and jump over towards my next and final question for the day. This is a little bit off topic, but everybody appreciates this. Based on the first week that we saw in football, we saw just about every team play. Well, we did see every team play. Some teams had some pretty good showouts. Some teams did not. But after week one, who is your Super Bowl prediction? I'm going to have to start it off with Alejandro.
I'm taking the Miami Dolphins. After watching Tua and Tyreek go off in game one, I think they have one of the most powerful offenses outside of the fact that they literally don't have a running back. in the NFL, and I think that the passing game is going to carry them to the bowl.
Dolphins for the Super Bowl, Alejandro. Money Mander, what do you got for me?
Ours is going to be easy, right? Both our teams are playing really well right now. I have to take my Birds. I will say that it was sick seeing DeAndre Swift have a good game because I grew up he went to a couple towns over to the high school, so I was watching him in high school. Knew he was a demon. Now he's back to Philly. That was awesome to see last night. I'm going to
He
take.
looks so good.
He looks so good.
Really good.
Awesome to see.
Yeah,
Probably be the best one here because I don't think he's going to take his Giants.
Diamond Trades, what you got for me?
I'm gonna take my New York Football Giant. No, I'm not. I'm probably going to go with the Chiefs. I like the Chiefs. I think that realistically, when you look at Patrick Mahomes, he has to be like every single time I watch this guy, I'm like, wow, this is clearly just the best quarterback that I've ever seen play. Like, and I truly think that when you have somebody like that, like you can never count them out. So I'm going to go with the Chiefs. I think it's a safe pick, in lieu of my Giants. Giants close second, though. I think this might be one of those years where the Giants are just ass, first 3 games, and then they squeak out like an 8-8, somehow make it to the playoffs because the NFC beats each other up, and then we'll see what happens.
One of those years that has not happened in decades.
We'll see what happens, fellas. Where are the Dolphins, dude? What?
What are you where are the Dolphins? They're the top of the AFC East. What are you talking about? Where are the Dolphins?
Enough out of you, honestly. I mean, they're constantly underperforming, and I think that you're one of those people that just
what is this guy talking?
You're holding on to hope. You're holding on to hope.
Hey, Diamond. How about you worry about your team scoring a point this season? And then we'll talk.
Yeah, scored 0 points.
That's gonna do it for this morning's episode before things get too heated. Unbelievable, this guy. All right. Hope you guys all had an awesome trading week. Hope everybody is ready to go today. We'll be trading live all day in the King Capital Discord. You guys can go to king-capital.com or scan the QR on the code. Appreciate everybody who tuned in, as always, on YouTube and on Twitter, supporting us. Really awesome stuff, guys. Outside of that, hope you guys have an awesome day and an even better weekend, and we'll catch you on Monday morning at 8:30 a.m. Eastern Time. Have a good one, guys.